The E-mini is trying to decide whether we've seen the low of the year. At the start of the year, I said that on the monthly chart, we were starting to get some pullbacks, and we were very overbought, and we had to pull back to the moving average. We could get there sideways or down. We tried to get there sideways here, unable, and back here in February, we got near the moving average, and I said that's not good enough. We have to touch the moving average, and therefore, we probably had to go more sideways to down. And we've sold off fairly strongly, but we were above the moving average for more than 20 bars. Traders have been willing to pay above an average price for a long time, and once they finally get the chance to buy at the average price, they usually buy. So usually you will not collapse below the moving average. The bears are trying to get a collapse below the moving average, and we are below it, but I don't think we're going to go much lower. There's a 30% chance we get all the way down here, the pre-pandemic high around 3,300. That means I think there's a 70% chance we're not going down here. We may go a little bit lower, but I think not much lower. And this is a common pattern right here where traders are looking for a bottom, and you have two legs down, and we might get a wedge. If we go below this low, this is the daily chart. If we go below this low, then we'll have a wedge, 1, 2, 3. And a lot of times, if traders are so confident that we're going to reverse up, they'll start to buy around that low or above that low. And instead of a wedge, you get a higher low. And over here, we had a wedge, 1, 2, 3. Other traders look at it as 1, 2, and then this formed a higher low. And it was a good candidate for a rally to a new high, but it failed. Instead, we ended up with a double top. And this is a second attempt at a bottom. And a second attempt at a bottom has a higher probability. The one problem the bulls have is the one that I've talked about repeatedly. They're not getting a good buy signal bar here or here or here. It's better here for the higher low, but they fail to get a good buy signal bar here or here. And that's true on the weekly chart as well. Weekly chart, the wedge is 1, 2, 3. You can call it a high 4, high 1, high 2, breakout, high 1, high 2, but no good buy signal bar. And that reduces the chances that this will end up being the low. But I do think if we go below this low, traders will buy it, and that will be the low for the year. So right now, I think either we've seen the low of the year, or that we'll get one more new low, and that will be the low of the year. Which is more likely? Have we seen the low, or will there be one more new low? Because of the absence of a strong buy signal bar on the daily chart and on the weekly chart, I think we're probably going to get one more new low. But if instead we start to do this and get a series of big bull bars, then this probably will remain the low for the year. I don't know that we have enough time to go up all the way back to the high, but I do think we'll get near it. I think we'll get 4,500, 4,600, maybe a new high by the end of the year. Back to the 5-minute chart. Going above yesterday's high. You can see on the daily chart, we've had 4 consecutive bear bars. That's good. That's buying pressure. That's relentless buying. So even though we don't have a really good buy signal bar at the low or at the higher low, that's a doji, we're starting to get bull bars. We have 4 consecutive bull bars. And that means the bulls are buying right up to the close of every bar, and it increases the chances that we're going to go higher. There's an increased chance that they will be sideways going into tomorrow's unemployment report, but I think a lot of the institutions already have their minds made up, and I think most of them believe what I said, that either we've seen the low or we'll make a new minor low, and that will be the low for the year. So I don't think there's much left to announce on. As I said, I think there's only a 30% chance of the market falling below the pre-pandemic high, even though on television all you see are bears. But that always happens when the market's going down. they'll only put bears on TV. And when the market goes up, they only put bulls on TV. So you cannot get an accurate sense of what is actually happening by watching television, because they want eyeballs. They want people to watch their shows. They're going to put in things that validate the opinions of the viewers if the market's going down. People want, they want to hear why it's going down, so they put on experts who believe it's going to go down more. It's just all nonsense. And you cannot. They don't put on both a bull and a bear. They put a bull on when it's going up and a bear on when it's going down. Now, for example, when's the last time you've seen Tom Lee on Fast Money? No, he's a perma-bull. He's always bullish. And with the market continuing to go down, he's invisible. And when it goes up, all the bears that they put on Wilson from Morgan Stanley, you won't see him anymore, Mike Wilson. Bears want a failed break on above yesterday's high, expanding triangle, 1 pullback 2, pullback 3. Yesterday was a pretty interesting rally. We had the FOMC minutes released here at 11 o'clock, and I always say don't do anything for 10 minutes, because the market usually makes a big move in both directions, and here we went up and down and up and down and up and down, and then we got that, and we had an 00 top, an outside bar and a bigger outside bar, and a big sell-off, a test of the open. We could not get down to the open, and that's bullish, and that's part of the reason why we're doing this. The bears tried to reverse this down to below the open of the day, and unable. We ended up with a bull body on the daily chart. The bulls want consecutive bull bars with at least one big and closing on this high. This would then be a by the close rally and a possible low of the day. First part of the day, if you don't know anything else about the context, the bars to the left, 20% chance the first bar will be either the high or low of the day. If the context is good, 25% chance. If the bar is good, for example, bar 1 is a big bull bar, and we've had 4 consecutive bull days. So right now, maybe 25% chance 1 will remain the low of the day. And if we get a second consecutive bull bar closing near its high, then probably 30% chance we've seen the low of the day. We've had a lot of traps on the open lately. Big moves up that reverse down, big moves down that reverse up, trading range behavior. So yesterday we went up and down, and then up again and down again. Consecutive big bear bars, and it soon led to the low of the day. Consecutive big bull bars, and we sold off. Big sell-off, reversed up. Big rally, and sideways, could not go higher. Big bull bar, high of the day. So that just illustrates the point that I say all the time. No matter how strong a move on the open is, 50% of the time it's a trap, and the market will go the other way. The market is testing. Do traders believe that it's the start of a bull trend? Will they keep buying, or will they decide that maybe it's not so good, maybe I'll take some profits, and will bears start to sell? Now, let's say 2 is a bull bar closing near its high. It's by the market, by the close, but your stop is below 1, so you're risking 20 points. So if you trade that, you have to trade small. And I always talk about having 2 position sizes, one your normal size, and then if ever you look and you're afraid to take a trade because the risk is too far, then you need a second size. And I always say make it 20% your normal size. So if you normally trade 1 E-mini, 20% of that is 2 micro E-minis. Now, this is a possible high of the day. Can you short below 2? If it looks like 74, yes. Okay, it does not. So now we have consecutive bull bars. one being big and closing near its high. So theoretically, it's by the close, but we have a possible expanding triangle. We had a new high here, bear bar, new high here, bear bar. So that lowers the probability for the bulls. So if you are buying the market here, I would trade small. Also, as I said, I think there's an increased chance of the market going sideways into tomorrow's unemployment report. Now, what happens if the unemployment starts to go up? Will the stock market go down because the economy is weakening, or will the stock market go up because the Fed will say, yes, we're achieving our goal, we're slowing the economy, and therefore we will not have to raise rates as much as we've said? And anytime you have an economic report, there's always a bullish interpretation and a bearish interpretation. So on TV, they'll only put either the bull guy on or the bear guy on ahead of the report. So the bear guy will be what I just said. If they choose, they won't put both. They'll put either a bull or a bear on tomorrow morning ahead of the report. I'm not going to watch it. But let's say they put a bear guy on, and he'll say, oh yeah, if the unemployment report is bad, if we're not creating jobs or if we're losing jobs, that means the economy is weakening and the stock market's too high. It has to go lower. And if it's a bad report and they put the bull guy on, he's going to say, yeah, the Fed should claim success, and they'll stop raising rates, and therefore it removes a headwind from the economy, and companies will be more profitable, and the stock market will go up. If you do buy the market at the close of 2 or the close of 3, you swing or scalp. It's a swing trade, but what will happen is if 3 does not go up fast enough, a lot of the bulls will scalp out 5 or 10 points. And if they're scalping out, if bulls are taking profits, it increases the chances that we'll get a reversal down. Bulls are hoping that we're just going to continue up in a bull trend from the open. Whenever you have a rally on the open, 20% chance it'll last all day, 20% chance it'll go up and you'll get a reversal, and 60% chance it'll go up and we'll go sideways. Right now, we're not anywhere near this. Right now, we're still a possible trading range open. Most days have a trading range open, but the more bull bars you get, the more bull bars closing near the high of the bar you get, the more likely we're going to get a bull trend that will last all day. Bears are hoping it's a bull trap and that will reverse down. They're hoping it's a strong rally that reverses down. Strong rally, reverse down. Now, 3 consecutive bull bars. In fact, you could say it's 7 bars without a bear body and a 7-bar bull microchannel. Probably more buyers than sellers below 3. Most bears will want a micro double top before shorting. So what do the bulls do? Is their stop still below 1? It is, but I think it's okay to get out maybe 5 points below 3. We may come down and test yesterday's high again. Very good bull bar 1, big bull bar closing on its high, but smaller bars 2 and 3 plus prominent tails. So hesitation, and that increases the chances that we'll get a pullback, maybe to yesterday's high. The bulls will hope it forms a high 1 and that the bull trend resumes up, and the bears are hoping that we'll reverse down like yesterday, 64.74. Traders are still buying the market, buying the close, buying above bars. They'll probably buy below 3. They'll probably buy below 4. We still have this big gap here. We closed this gap. We did not close that gap. Now, is this gap going to close? 100% certain it's going to close. What is not certain is, will it close on this rally or will it close later in the year? But all gaps down close, but not all gaps up. Why do I say that? Well, because, obviously because it's true, but let me explain why it's true. Here's a daily chart. Market's in a bull trend forever, and that means it keeps making new highs and higher lows and higher highs. So anytime you get a gap up, especially from a big sell-off, that gap may never close. For example, this gap may never close. But when you get gaps down, the market on the yearly chart is always in a bull trend. It always has been in a bull trend. There's never been a bear trend on the yearly chart. That means you always expect new highs. And if you get a new high on the yearly chart, then you're going above this high. And that means every gap down will close. It's just a question of when. This gap is going to close. But we sold off 35% before it closed. But every gap down closes. But on the way up, sometimes the market never gets back to test below. So gaps up do not have to close. There's a big gap up, and it never closed. It just kept going up. Gap down here, it did close. So whenever you're at a major low, here, big gap up, never closed, and it never will. We're never going down here. To go down to that price, 1900, we'd have to lose 60 or 70%. And the market sometimes does lose 60 or 70%. Here's the cash index right here. And the market was down 56% here, and I think 60 or 70% here. So every 10 or 20 years, you're going to get a 60% correction. But, from what level? If we get a 60% correction from here, we'll be down here at the pandemic low. But if we go higher and then get a 60% correction, we'll only be down to 3,000. So we may never see this price again. Like we never saw that price again, and we never will. That's at 700. We'd need a 90% correction to get down here. But the highs, prior highs, we're always going to get a new high. But the lows, you're not always going to get another new low. So bulls, they're disappointed. 2, 3, 4, not very big. It's still by the close. Probably buyers below 4. A 9-bar bull microchannel since 77. So bulls have been buying at and above the low of the prior bar for 9 bars. And there will be bulls eager to buy at the low of the prior bar. So there'll be buyers at the 4 low and below. That makes selling below 5 a low probability bet. It's a micro wedge, up on 2, down on 2, up on 3, down on 3, and then up on 4, down on 5. So if I look at a 1-minute chart, this is probably a wedge. Let me look at a wedge in a 1-minute chart. So a little wedge, 1, 2, and 3, but it's minor. And on a 5-minute chart, it's a bull microchannel. So it'll be a pullback, but not a reversal. What happens if we get 2 big bear bars closing on their lows, or 3? The more bear bars you get, the higher the probability that we've begun a swing down. But right now, at this moment, there probably are more buyers than sellers below 4. And if we go below 4, it'll probably be for only a bar or 2. Like yesterday, 64. a possible reversal, but really strong buying, probably minor, maybe a couple legs sideways. So that I did not sell below 64. I did buy above 68. So I'm not going to sell below 5. Now, why are we stopping right here? The market's telling you something. What is it telling you? It says the bulls who bought one tick above 1 were able to make 10 points. So that means that the scalp right now, the scalp price is 10 points, maybe 5 points. So bulls will try to scalp for 10 points. And that's why 5 looks this way. Some of the bulls who bought above 1, disappointed 2, 3, 4, decided to take some or full profits 10 points above their entry price. Any reversal from a new high can be the high of the day. But 8 bars without a bear body, it's a low probability short below 5. I think it's better to wait for a micro double top or for 2 or 3 bear bars before shorting. A bear bar, but only a doji, big tail below. So reasonable to exit longs 5 points below any bar, below bar 5, but there probably will be more buyers at the 5 low and 5 points below and 10 points below and at yesterday's high. So I think it's too early to short. This is now a 10 bar bull micro channel since bar 77. Odds are high that traders will buy the first reversal down. It's not so good for buy the closed bulls. The bodies are getting small, and now we have a bear bar. There might be sellers above 5, but the bears who will sell with limit orders. They'll use wide stops and they'll scale in and they'll scalp. If you're looking to short, I'd wait for a stop entry sell, and it's too early to sell below 5 or 6. I'd wait for 2 or 3 bear bars or a second reversal down. We have not even had a first reversal down yet. Of the first 6 bars, we have 1 big trend bar and 5 smaller bars with a lot of overlap among the bars and prominent tails. Increases the chances that we're going to enter a trading range. This could still be a small pullback bull trend day. Most small pullback bull trend days that last all day look like this. Disappointing bars, tails, a lot of overlap, but they just keep going up and up and up. And why do they keep going up? Because bulls know one of 2 things will happen if they buy. If they buy, it'll keep going up, good for the bulls. If they buy and it goes down, the best the bears will get is a trading range. And if it's a trading range, after it goes down, it'll go back up, and they can get off break even on their first buy. So they'll buy the market, and they're willing to buy more, 5 or 10 or 15 points lower, expecting the first reversal down will not begin a bear trend. It'll begin a trading range, and we'll get a bull leg, and they can get out around break even on their first buy with a profit on their lower buy. And that's how these small pullback bull trends can last all day. The bears don't want to sell, and the bulls are not confident that the bull trend will keep going up, but they are confident we're not going to get a bear trend. So they just keep buying, and as it goes up, they buy more, it goes up, they buy more, and they buy small. And you can see prominent tails, bear bars. Bars are not big. Sometimes you can get a bull trend from the open that lasts all day, and it can have a lot of big bars. But most of the small pullback bull trends don't look all that bullish. They have a lot of tails, a lot of bear bars, but the pullbacks are small, 1 or 2 bars, 2 or 3 small bars. So right now, this is what today looks like. 20% chance we're going to go up a lot higher, but 80% chance we're going to form a trading range soon. First reversal down, they're going to buy it. Like this, too many bull bars, they'll buy the first reversal down. And might get a small trading range like that, might get a trading range that lasts more bars, may get a deeper pullback, but we're probably going to do something like this starting soon. First reversal down, they'll probably buy. What do you do as an individual trader? I think you're either long or flat, and both are reasonable. It looks like a lot of the bulls who bought above 1 scalped out for 10 points, and a lot of them are hoping for a pullback, a high 1. If the trend is not very strong, a lot of the bulls prefer to not buy at the high. They prefer to buy lower. Inside bar, about 2 bear dojis, so not a very good high 1. Probably buyers above, but today 6 bars in the micro channel, and then if you had yesterday 5 more bars, that's 11 bar bull micro channel. Probably more buyers at the 6 low and lower, 5 points lower, 10 points lower at yesterday's high, a 50% pullback. So different bulls will buy for different reasons. Whenever you don't know anything about what the market might do, reversal, the first thing I always do is where's a 50% pullback? And of today's range, 50% is there, but it could be a 50% pullback from this low. And it's right around the low of the day. And that's part of the reason why this high is exactly there. The computers were wondering, well, maybe it'll test this low. So how far up do we have to go so that low is a 50% pullback from 77? And that's part of the reason that high is right there. Computers are playing chess. Right? They're always thinking of things 2 or 3 steps in advance. So when one formed, we had no idea that there would be a bunch of sell orders. A measure move up from the start of the bull trend 77 to the low of 1, but there were. We're near a 50% pullback, so you'll get bulls starting to buy 5 points below 6, 50% pullback, and at yesterday's high. This is 3 consecutive bear bars, so that means we've had 2 consecutive bear bars. The bears want 7 to be big and closing near its low. That would increase the number of bears willing to sell the close of 7 and below 7. But I'd like to see 2 bigger bear bars. 6 is not good enough for me to sell 7, especially when it's an 11 bar bull micro channel. This is like a little spike and channel pattern, spike, pause, channel, little micro wedge. Market tends to like to test at the start of the channel, which is the 2 low, and it's also a 50% pullback. Bulls okay to get out 5 points below 6, but this is probably a minor reversal. Remember, I said right from the open, most likely we would have a trading range open, and it could be sideways like this, or it could be all the way back down to this or below. That's what the market's deciding. Will traders buy the close of the bear bar and will we go back up, or will traders sell it and will we get down here? So big bear bar, yes, but there might be more traders buying the close than selling the close. For the bulls who did not get out below 6 or 5 points below 6, what do? Do they get out below 7 or do they keep a stop below 1? They could do either one. Now we're at 50%. Are the bulls going to buy it? Or is the rally a bull trap? And have we begun a bear trend? The bears need to do more before I think traders will conclude that we're in a bear trend. But there might be more buyers than sellers at the close of 7. 11 bar bull micro channel, 50% pullback, test of yesterday's high. So this might be just a test instead of a bear trend. you can see there's buying going on. Some of it is bears buying back shorts, and some of it is bulls buying the 50% pullback in the test of yesterday's high. Now, I'm sure most of you are not aware of it. Well, look at where the low of 7 is. It's 41 ticks below 6. So what? Well, if you sold 1 tick below 6, it has to go 42 ticks lower for you to make 10 points. And that tells you that there are a lot of buy limit orders 41 ticks below 6. So the bears, a lot of the bears are scalping. They're trying to get a 10-point scalp. And the bulls know that. And the bulls are therefore buying around around 41 ticks below 6. The bulls trying to trap the bears. And then the other bulls are buying 10 points below 6 and at 50% pullback. 3 consecutive bear bars, but 2 are dojis, and the third one has a fairly prominent tail. So that's not enough to attract a lot of sellers, given that today has a 6-bar bull microchannel. 6, a bad sell signal bar. So buyers, some bulls bought the 6 low, they bought more 5 points lower, 10 points lower, expecting it to at least get back 1 tick above the 6 low. The bulls who bought 10 points down, scalped 5 points up. Bears are hoping this is the high of the day. Everybody knows, well, that's not true. Experienced traders know we're probably going to enter a trading range. This is probably the start of a trading range and not the start of a bear trend. But as I said, if we keep getting bear bars, especially bear bars closing near their lows, and if we break below 1, this could end up being the high of the day. Right now, more likely, it's a minor reversal. You can see there were buyers below 7. Who are those buyers? The bears that sold below 6 needed it to fall 42 ticks. It just fell 42 ticks, so a lot of the bears who sold below 6 are scalping out for 10 points. And then you also have traders thinking 7's a bad sell, so probably more buyers than sellers below 7. So they had limit orders. Bulls had limit orders to buy the 7 low. High 1, 8. Trading range likely. A bear surprise bar. And therefore, probably not a resumption of the bull trend. So it looks like we're going to be sideways for at least several more bars. We might be doing this. So rally, big bear bar, couple bear bars, and then this. You don't want to buy too high, and you don't want to sell too low. So high 1 for the bulls, but a bear surprise bar 7. Room to the moving average, room to yesterday's high. So this is not a scalp. If you're buying above 8, you're taking a chance that we're going to go far above the old high. And you know the odds are against it. However, you're not risking much, 6.7 points, and you might make 20 or 30 or 40 points. So it's an okay swing trade. It's not an okay scalp trade. Will bears sell the high of 8? It's a high 1 and a bull trend. A bear surprise 7 might get a second leg sideways to down. Probably will get a second leg sideways to down. But I'm not willing to sell above a bull bar in a bull trend, plus above the moving average. So you're either buying here above 8, or you're waiting for 2 or 3 bull bars, or for a second leg down and a high 2 at the moving average. And for the bears, I personally am not selling above 8, and I'm not going to sell below 9. The bears are hoping. 5 is the high of the day. 7 is a spike down. 8, 9 pullback, and then we begin a channel down like yesterday. 9 was a spike down. We bounced and channeled down. Here, 7's a spike down. We bounced, and the bears are hoping we do this. Things are not clear. That means confused. Confusion is one of the hallmarks of a trading range. When traders are confused, they tend to buy low, and they tend to sell high, and they tend to take quick profits. They scalp. Also, you'll get traders more willing to enter with limit orders. Stop orders are bets on trends. If you're in a trading range, a trend bet is a low probability bet, so you'll get a lot of traders betting against it. So a bull bar 8, you'll get some traders selling the high of 8, betting the bulls buying above 8 will not make money. A lot of small bars, that increases the chances that we're going to have a lot of trading range trading today. Sideways bars, that means hesitation, and hesitation means lack of conviction. Traders think the price is just about right, and the market's probably not going to go far in either direction. So you get fewer traders willing to enter with stops betting on trends. The bears a low 1 below 9. I would not sell it. The bulls a high 1 above 8. I do think we're going to get up to the high of the day, but we may get another leg down. We may test the 1 low before we get there. 4 of the past 5 bars, dojis. So no energy, no conviction. Price is just about right. Buyers 9 low, buyers 8 low, buyers yesterday's high, buyers at the moving average. So a low probability short below 9. The bulls a high 1, 8, but a doji magnets below yesterday's high, the moving average. And for the bears a low 1, expanding triangle 64, 74, but a doji and probably buyers below at the moving average at yesterday's high. No great reason to do anything. Always in long. So if I have to do anything, I'm buying the market and putting a stop below 8, taking a chance that this is a breakout test, a test of the breakout point, yesterday's high. Getting late in the hour, traders are deciding, will the 60-minute bar close on its high? That would increase the chances that we go higher. Or will it not close on its high? Increasing the chances that we'll pull back. That's the next target, that, and then this gap over here. This is the 60-minute chart. It's the same gap that I showed on the daily chart. Don't get upset and don't take any of this personally, right? You know, everybody wants to trade, everybody wants to make money. But most traders should be entering with stops and swing trading. And this is a limit order market and scalping. So it's the exact opposite of what you should be trading. There will be some swing trades, but when you have a lot of trading range trading like this, you often have to wait a long time. But don't worry about it, right? Some days are mostly trend days with lots of stop entries. Other days are mostly trading range days, which means mostly limit order entries. And so far, this is a limit order day. You know, except for bar 1, every bar today has at least one prominent tail. And that means it went one way and then it went the other way. That's a sign the market lacks conviction. It's going both ways on every bar. Low 1, possible high of the day, but not a good enough sell signal. The tail on the bottom of 7, and then 3 bars with tails, 7, 8, 9. In fact, we've had 9 bars with tails since bar 2, tails below. So that means when it goes down, they buy. You want to sell below 9 when they've been buying every time it goes down? not very good. Looks like we're going to dip back below yesterday's high, but the bears need to do more to convince traders that this is the start of a bear trend. More likely, it's a pullback from the rally up to 4. If we get a couple big bear bars closing on their lows, closing below the moving average, then traders will conclude this is the high of the day and that we've begun a trend. But without that, this is still more likely a pullback from the rally to 5. I would prefer the market to dip below yesterday's high, touch the moving average, and then reverse up. Whenever it is reversing up from just above obvious magnets and the market is not all that bullish, there's less of a chance the reversal up will be successful, and there's a better than 50-50 chance we have to get below yesterday's high and down to the moving average. Traders will be more confident to buy, more willing to buy, if they feel like support has been fully tested. If they feel like it has not been adequately tested and we start to go up, many bulls will not want to buy because they'll feel like we are probably going to go down and get that support and then decide whether to go up or down. A bear outside down bar, what do? They bought. They bought the bear close. They bought the low of 9. They bought the low of 10. So anything bearish, they're going to buy. A high 1.8, that's bullish, they're going to sell. And traders are betting that attempts to trend will fail. High 2, still a breakout test yesterday's high. This is a higher probability buy than 8, but what's the problem? The problem is small bar. Why is that a problem? Why is the small buy signal bar a problem? Well, because the risk is small. And the smaller your risk, that means the better your risk reward. And risk reward is inverse to probability. So if you have fantastic risk reward, you have low probability. Your stop is probably going to get hit. Relatively small buy signal bar. Small buy signal bar. And so the risk is small. That means the probability is low. And if you take a buy above a small buy signal bar, it's better not to put the stop just below. It's better to put it maybe a measured move down based upon the height of the bar. Small buy signal bar, a high 2 like today. Well, better if you buy not to put the stop just below, better to put it maybe twice the height of the bar. So if you buy here, which is okay, instead of putting a stop just below 11, it's probably better to put it on maybe a measured move down, maybe 4 or 5 points below 11. Can we collapse below 11? Sure, but we probably won't. Some bulls, instead of buying here at the market above 11, will wait for 2 or 3 bull bars and then buy, which is okay. And for the bears, they have a double top 10, but I still would not sell. We're still always in long. We're still above the moving average. Probably more buyers than sellers below 11. How can that be? It's a failed high 2 because it's a reasonable buy in a small buy signal bar. And most bulls know that you probably need a wide stop, that it's a tight trading range, probably more buyers below. What happens if 12 is a bear bar? You could get out below 12 instead of 4 or 5 points below 10. That's the end of the first hour. Consecutive bull bars closing on their highs. Good for the bulls. The bears are hoping that this is a low 2 pullback from 7 and that we go lower. And bulls are hoping we successfully break above 10. Some of the bulls who bought above 11 disappointed 12 was not bigger, and they're scalping out 5 points here on 13. If enough scalp out, we'll get a bear bar. 13, closing there is low, and bears will sell, looking for a second leg down. So leg 1, and then an ABC bounce, a low 2 bounce, and then leg 2. We're testing the 6 low. Remember I said bulls would buy the 6 low and 5 or 10 points lower, and a lot of them will exit if they're sufficiently disappointed. A lot of them will exit around their first buy at the 6 low. That's where we are now. Now, are the bulls going to exit and will we get a reversal down 13? Or will they not exit and will other bulls buy more? And will we get a third bull bar? Remember, bar 1, I said probably a trading range open. 2, 3, 4, I said probably a trading range open. And this is still a trading range open. Right now, the bulls are hoping the bull trend is resuming, but they need to get more bull bars. They need to get big bull bars. They need to get big bull bars closing on their highs. When a trend does not look strong, it's reasonable to buy small and then buy more as it goes up. I would get out maybe 2 or 3 points below a bull bar. The bars are getting small. I'd get out 1 tick below a bear bar, closing below its midpoint. Bulls are trying to break above 5, and the bears will try to get a double top 5. Daily chart of Apple. We have a lot of bull bars, even though we've sold off since the first of the year. A lot of bull bars. This does not look like we're going to go a lot lower. It looks like the bear trend might be ending, and we're either converting into a trading range or the bull trend is resuming. Alphabet, a lot of bull bars down here, converting into a trading range or the bull trend is resuming. Alphabet, a lot of bull bars down here. Microsoft, look at since here, a lot of bull bars. So on the daily chart, I keep saying daily and weekly chart, we've done what I thought we would do for the year. We may go a little bit lower. I thought the sell-off would last 3 or 4 months. So far, this is the 7th month. But I still think it's we're going to rally the second half of the year. The market simply deciding, has the rally begun with the June low? And it's not clear because we have not yet had a strong reversal up, and we did not have a strong buy signal bar. By the way, I talked about how most bottoms have good buy signal bars, but the collapse we had in 2018 over here, we had 10 consecutive bear bars, yet we reversed up violently. So that was a very climactic sell-off and pretty good reversal here or here. And V-bottom. V-bottoms are unusual. Most bottoms most bottoms are major trend reversal bottoms or wedge bottoms. 3 consecutive bull bars closing near their highs. So it's a change in character. Look at the bars from 2 through 11. All had tails. And now we have 3 bars closing near their highs, with only small tails below 10 and 11. Bears want a low 2 and a second leg down. Bulls, I'd get out 2 or 3 points below a bull bar 13. I'd get out one tick below a bear bar closing below its midpoint, maybe 14. For the bears, a lower high major trend reversal, so a lower high double top. What about shorting below 14? I said I would not sell below 6 because it was probably a minor reversal. I said the bears will want some kind of a double top or a second reversal down. This is it. So if 14 closes near a slow, it's a reasonable swing sell. Can you scalp below 14? Probably not. Because a lot of times in bull trends, you'll get bear bars, 64 yesterday. And if the trend is strong, there'll be more buyers than sellers below the low of the bar. So is this a strong enough bar to short below 14? I'm not going to. We've been above the moving average for 14 bars. It's a tight trading range. So more likely, if it goes below 14, it'll only be a leg in the trading range. So it's okay to sell below 14, just like it's okay to buy above 11 or 12 or 13, but we're still in the tight trading range. So it's swing trading. You buy, you sell, you hope for a big move up. If you don't get it, you scalp out. And the bears will do that below 14, just like the bulls above 11 and 12. It looks like they scalped out. A bull bar 13, so bulls bought the low of 13, but I would get out below 14 if it closes below its midpoint. You can always buy again if 15 is a bull bar. Yesterday, if you get out below 64, you can buy above 66 or 68. Outside down, bear bar closing in its middle. Okay to exit longs below 14, but I think not good enough to go short. For the bears, a low 2, 9, a lower high double top 5, so a possible lower high major trend reversal. But more likely, we're always in long, and more likely buyers below 13. But I would get out below 14. Not good enough to short, but good enough for the bears, good enough to get out of longs. Right now, the bulls have bought above 11, 12, 13. I think they should still be long, but I think it's okay to get out below 14. You should be confused, right? The market is confused. It's slightly more bullish than bearish, but we're still at the top of a trading range open. So it's not clearly bullish or bearish. It's more bullish than bearish. Are we going to go below the 14 low? Well, we're probably in a trading range open. And in trading ranges, the market does things to disappoint bulls and bears. The bulls are on a buy, and it would disappoint them if it goes below 14. So I think we're going to go below 14. If we do not, then the small pullback bull trend is intact. Well, it's a trading range open, lots of small bars, lots of reversals, and therefore you always have to assume anything bullish is going to attract a lot of sellers. Can you short below 14? Well, I would not. What happens if it's a bear bar closing on a low of 15, and it'll have consecutive bear bars? Could you short below 15? It would be a higher probability. You can just see all the buyers below 14. As soon as it went below 14, it snapped up, right? So it's still a lot of eager bulls. If you get out below a bear bar and it's still a possible small pullback bull trend, you can buy above a bull bar 15 or above the prior high 14. But until we clearly break out of this trading range open, it's better not to be buying with stops at the high above 14, above 5. Better to buy pullbacks. 11, if you get disappointed, scalp out 5 points. For the bears, consecutive bear bars, a lower high, but probably a minor reversal, probably not a lower high major trend reversal. So I would wait to sell. Wait for what? Wait for a strong break below the moving average, maybe a couple closes below the moving average. You can see it's bearish. They bought it. They bought the 14 low, the 15 low. Yesterday, bar 28. Look at the rally. You know, it went up for 30 bars over 2 hours, and it never looked all that strong. And this is a comparable thing. The bulls are hoping that this is a small pullback bull trend, and that it lasts a couple hours, and that we go far above 5. 3,900, big round number, magnet above. And then on the daily chart, last week's high, there's a magnet above, and then that gap, closing that gap. That's, I think, too far to get there today. And it's still probably too far to get to last week's high today, especially given all the small bars that we've had, and given that tomorrow's unemployment report is really important. So I think a lot of the traders will not want to get too bullish ahead of the report. For the bulls, a high 1, but 2 bear bars, and a possible wedge, 10, 14. So not a lot of buyers above 15, not a lot of buyers above 14. Very often, you'll get a double top with the second leg being a wedge. And that reduces the number of bulls willing to buy above 14, even though always in bulls theoretically buy above the most recent high, 14, or above a bull bar closing there as high, 16. So it's a possible third leg up, 3 highs, 10, 14, and maybe 16 or 17. And the market often reverses around bar 18. So, okay to be long on a stop 1 tick above 14 or 1 tick above 16, but possible wedge and double top. Small pullback bull trend, but possible continued trading range. I did not buy above 14. So I'll wait to see if we get a strong breakout above 5 and then buy again, or wait for a pullback, maybe a double bottom 11 at the moving average. Possible wedge rally to a double top. Remember, the bears wanted a wedge rally to a double top, and we're breaking above that 5 high with consecutive decent bull bars. So this is becoming by the close again. Can the breakout fail? Sure, but when you get consecutive bull bars closing near their highs, it's more likely by the close and will probably go higher. The more 17 closes on its high, the more likely we'll go higher, maybe up to 3,900. What happens if 18 is a bear bar? Well, then this is a bull trap. Bulls will get out, and bears will bear short. Well, 16, 17 is a bull surprise, so we'll probably get at least a small second leg up. So the bears would need a pretty impressive bear bar to attract traders below 18. Remember, the market often reverses around bar 18. This is bar 18. So the bears, higher height, double top, a wedge, and a bull trap. Reasonable for bulls to exit below a bear bar closing below its midpoint. And it's a possible high of the day. But with the consecutive decent bull bar 16, 17, I think it's better to wait for a second reversal down. Will the bulls buy the close of 18, or will the bears sell and trigger the short below 18? We'll find out. It's bullish if 19 does not go below 18. It's bad for the bulls if it does. A lot of the bulls will exit. They can always buy again above a bull bar, maybe 19 or 20. Will disappointed bulls exit around 17 close, or even with a small loss a little below 17? Or will they hold long and buy more above 19? Possible II here. So far, bulls bought the close of 18 and they prevented 19 from going below 18. Bulls were hoping 18 is a breakout test, 14, and that will continue up to 3,900. You can see the measured move is almost exactly there. Still on the buy above 16, still buy the close 17, but possible low 4. 16, 17, a little surprise. Traders expected a second leg sideways to up 19. Now, the bulls, are they so disappointed 18 that they're going to get out here? Or will they buy more and get us up to 3,900? Big round number, magnet, chances are we're going to go higher. But if we get a second bear bar, I think bulls will get out and bears will short. What do? You sell below 20? I'd get out of longs on below 18, a bear bar. If 20 is a bear bar and it has at least a 2-point tall body, I'd get out of longs below 20. And for the bears, it's a low 4. We had a low 1, low 2 at 14, a breakout, and then an attempt at a low 1, an attempt at a low 2, 20. So it's a type of a low 4. Possible high of the day. So it's an okay swing short, but it's probably going to be a minor reversal. Bulls, I'd get out below a bear bar. If it looks like this, I'd get out below. And bears, it's not a strong sell, but if you sell, you have to be going for a swing because it's a low probability bet. It's still a small pullback bull trend, and that lowers the probability of bears shorting below 20. I did not short below 20. I did buy the close of 17, actually a little bit better than the close of 17. Disappointed at 18. I got out break even, so I'm back to flat. The reasons why I did not short below 20: a small bear body, small pullback bull trend, measured move above, and 3,900 big round number above. Plus, we've been above the moving average for 20 bars. That reduces the chances that we'll get a big reversal down. Consecutive bear bars, so better for the bears. You'll get more bears willing to short below 21. I'm currently flat. For the bulls, it's a high 1, but we're starting to get bear bars, 3 bear bars. So I'm not willing to buy above 21. I am flat, but if I had to choose long or short right now, I'd choose short. However, it's probably a minor reversal. High 1, but consecutive bear bars. Might be more sellers, 21 high, than buyers. I'm not willing to take the buy. Micro double top, still on the low 4, sell 20. You can see some bears sold the 21 high, but they did not make much money. Bulls hoping for a high 2, 23. It's a high 2 if it goes outside up. We'd have 2 legs down on 21, up on 22, down on 23. Bears hoping that this is the start of a swing down. Traders have been willing to pay an above average price for 2 hours now. So you have to assume they'll be happy to pay an average price. And moving average is one measure of an average price. So there probably are buyers around the moving average. My last trade was buying 17. I considered selling above 18 and above 21, but I did not do either because of the tight bull channel and so many bars above the moving average, probably limited downside. Bulls hoping for a high 2 like 68. They'd like to get a bull bar closing near its high. They're trying to get to 3,900. They're trying to keep the gap open above 14. This is another test of the 14 high, just like 18. Can they get a good bull bar 24? The lack of clarity is consistent with a trading range. Even though we're at a new high, it still could be a trading range open. Since bar 2, most of the bars have had tails and most of the bars overlapped the prior bar by a lot. And that is not how bull trends look when they last all day. It's possible that the day could get a lot stronger, a lot more bullish, but so far this does not look like it's going to lead to a big bull trend. Trading range open, possible bottom of the range, 8 low, yesterday's high. Limit order bulls trying to buy around the moving average. The trend is not strong, and therefore will probably reach the moving average on this bar or within a couple bars. So the bulls are high 2, but they'll need a very good bull bar 23 to attract buyers, and they're probably not going to get it. We're probably going to go at least a little bit more down to the moving average. Bears, I did out above 23, a high 2, but for the bulls, 4 bars without a bull body, so I would not buy above 23. Can you sell the close? 4 bear bars? Nope, we're still above the moving average for 23, 24, 23 bars. And we're still always in long, and we're still in a small pullback bull trend. But it's probably a trading range. 20 might be the high. Maybe we got one more leg up for a wedge, 5, 20, and maybe 24, 25. You can see the bears are sold below 22. They scalped, but they got stuck. They wanted to get 5 points. It had to fall 22 ticks. It fell 20 ticks. And that's part of the reason for that tail of 23. You got bears who sold below 22, deciding it's probably a minor reversal. It's not falling fast. They place a limit order to get out with 5 points. So their limit order is 21 ticks below 22. It has to fall 22 ticks below. It only fell 20 ticks below and started to bounce. And those bears quickly bought back their shorts. And that resulted in the big tail on the bottom of 23. Bears buying back shorts. There are some bulls who bought. They tried to buy 5 points below 22, but it had to fall 21 ticks below 22 for most of those buy orders to get filled. It only fell 20 ticks below. So you still have bulls trying to buy below. You have bulls trying to buy at the moving average. Do I think we're going to get to 3,900 today? At this moment, I do. But if we keep going down and if we accelerate down, then we probably will not. Is this going to continue all day as a small pullback bull trend? Probably not. Too many sideways bars. Here, 4 bars, 4 bars, 4 bars, 6 or 7 bars. And we have a breakout, 16-17, not big. Small pullback bull trends that last all day usually have two reasonably good breakouts in the first couple of hours. We've had one, but we have not had two, and also the one that we've had is not especially strong. Without at least a couple strong breakouts in the first couple of hours or so, the odds of a trend lasting all day is small. What's small? 30%, 40%, maybe 30%. High 2 for the bulls, but will 24 close on its high. And we also have that moving average problem. I talked about that on the monthly chart back in February over here. In February, at the end of February, I said, it's a problem. We did not reach the moving average, and with 4 bear bars in the past 7 bars, 6 bars, we really have to get to the moving average. And I said we probably cannot go up much until after we dip below the moving average. And we could not get up much, and we did fall below the moving average. And that same kind of thing is going on here on the 5-minute chart. We're not getting very far above the moving average. Bulls want to see if the bulls will buy the moving average. So bulls are hesitant to buy. We're just hanging around support, the moving average, for too many bars. So bulls expect it to dip below the moving average. And a lot of bulls are hesitant to buy if it's failing to accelerate far up above the average price. And it's failing to accelerate far up above the average price. So we have to probably dip below that average price. The bears want a reversal down, breakout, bull breakout 16-17, and bears want a big bear breakout. A couple bear bars closing on their lows below the moving average. And then they hope we get down to yesterday's close and the 60-minute moving average. Whenever a day might be a trading range day, I always pay attention to the open of the day. It sometimes is the middle of the day. So if this is the middle of the day, the low of the day would be around that 77 close and the 60-minute moving average, both our support. I'll get rid of this. 5 bear bars, or 5 bars without a bull body. Not good to buy. What about the 20 gap bar bulls? Will they buy the moving average? With the 5 bear bars, I would not put a limit order to buy the moving average. If we reverse up strongly from the moving average, I might buy. Well, with the 5 bear bars, there will be fewer bulls willing to buy above 25. Did we get to the moving average? Well, let's see. There's a gap between the 25 low and the moving average. But if 25 closes up here, the moving average will get pulled above the low of the bar. And then when you look at the chart at the end of the day, you'll say, oh yeah, 25 pulled back to the moving average. And that will not be true. We would never have touched the moving average, but the moving average is based on the close of the bar. And if the close is high enough, that blue line will get pulled above the low of the bar. So it'll look like we touched the moving average, but in fact, we did not. And that's good enough. If it looks like it touched, most traders and most computers are going to say it touched. If you do some kind of test at the end of the day of buying at the moving average, right? It'll show that you get filled at the moving average. If this bar closes up here and the moving average gets pulled up above the 25 low, and your computer program will show that you get filled buying at the moving average. But in fact, you would not have been filled. That's one of the many problems with testing trading ideas. Sometimes you'll get fills based upon what you wrote for your algorithm, but in actual fact, in real time, those fills would never have happened. 24, a multiple of 12, it corresponds to the close of a 60-minute bar. And for the 60-minute chart, it's a wedge, different ways to draw it. 1, 2, 3, or 1, 2, 3. It closed below its midpoint, so it's a reversal bar, but it's a bull bar, and we have consecutive bull bars, and we're in a small pullback bull trend. So it's not worth selling on the 60-minute chart below the low of that bar. 5-minute chart, we're not getting bull bars. But so far, it's not strong enough to be selling at the low. Probably most of the bears who sold below 20 and 22 will scalp 5 points. Maybe they'll try for 10 points. Micro double bottom, 20 gap bar buy. This is 25 is exactly what I was saying about the moving average. You can see as the bar goes up, the blue line gets pulled further and further above the low of the bar. And I was not looking at when the bar was on the low, but I do not think the bar ever touched the moving average. But because it's now a bull bar, the moving average got pulled up below the low of the bar. When you look at the chart at the end of the day, you say, it pulled back to below the moving average, and therefore bulls bought the moving average. But that's not true. The bulls were unable to buy at the moving average because it never got to the moving average. So it's a 20 gap bar buy. On the chart, we touched the moving average, but in real time, we did not. It's a high 2, but it's also 5 bars without a bull body. So that's a low probability buy. I think this will be a minor reversal. Would I short the 25 high? No. Would I buy the 25 high? I'm not. But if I did, I'd use a wide stop and scale in lower. I'd rather wait for it to stop going down, start to go sideways for a few bars, and then get a second bull bar and buy above that. Bears, I'd get out above a bull bar. We're still always in long. It's a 20 gap bar buy. It's a bull bar closing near its high. And we have magnets above the high of the day in 3,900. But I think it's good enough to get out of shorts, but it's not good enough for me to get long. Bears are selling the market. It's similar to 18 close. Bulls bought the close. They did not want the market to go below the bear bar. The bears do not want 26 to go above a bull bar because they know a lot of bears will buy back shorts and a lot of bulls will buy. And if you're short, you'll probably get out. The bears want it to go a lot lower, and they want to make a lot more money before it reverses back up. So not a good buy, but good enough to exit shorts. Will a lot of bulls buy this, and will we go up to a new high? Or will there be an absence of buyers, and will we drift down lower? Bears, if I were short, I'd get out. Some bears will sell the 25 high, betting that it's not a good buy, and therefore will go more sideways to down. I would not. We're still always in long, and it's a 20 gap bar buy. When traders see a rally, and we might get a third push up, but traders think the rally is weak, and that if we go to a third push up above 20, we'll form a wedge. A lot of traders start to sell before we go above 20, and sometimes you'll get a lower high double top, and then reversal down, and I call that a truncated wedge, where it's basically the same forces as a wedge, but the bears were so confident we would reverse down, they started selling before it made the third new high. So it's a wedge with the third high not above the second, so it's truncated. You can go to head and shoulders top, a lower high major trend reversal. I use the term truncated wedge. I still think we're going up to 3,900 and above bar 20, but because of 5 bars without a bull body, I did not buy above 25. The bears are hoping small pullback bear trend, low 126. But 5 bar tight trading range just above the moving average. It's not good enough for me to sell. So not good enough to buy, not good enough to sell. With stops, that means probably more limit order traders. They sell above things, above 25, 26, they sell more higher, and they buy below things, 26 low, 25 low, and they buy more lower. Best choice for most traders right here is flat. Second best choice, long, stop below 25. And shorting, I think, is not a good choice at the moment. I think it's good to be out of shorts, but I would not short below 27. Tight trading range right above the moving average, low probability. Why the bear bar 26? Why the tail 27? Because bulls are hesitant to buy too high. They're afraid that 20 might be the top of the trading range. For the bears, 2 little legs up, 25, 27, but nobody wants to sell below a bull bar just above the moving average. So it's still on the buy 25, but disappointing, and not a lot of new buyers. And for the bears, a low 127, probably buyers below. So always in long, I'd get out a tick below 25, or if 28 is a bear bar closing near slow, I'd get out below 28. Most traders, this is not what they want. 25 reasonable buy, 26 disappointing. Okay to exit at the market, okay to hold long, but very tight range for 10 bars since 18. I think best choice is flat. This is not good trading for stop entry traders. Will the bulls who bought 25 scalp out at 5 points, creating a lower high double top, or will they continue to buy the close, trying to get us up to 3,900? I'd get out a couple points below a bull bar 28 and 1 tick below a bear bar closing below its midpoint. Always in long. Odds favor higher, but this is not strongly bullish at the moment. Bulls buying small, just in case we keep going up. They'll buy more higher, and they won't lose much if we reverse down. And for the bears, they're expecting a wedge reversal. But if enough traders believe there'll be sellers above 20, they'll start to sell below the 20 high, and we'll get a lower high, a truncated wedge. If enough traders believe the rally is going to lead to a reversal, a wedge top, you'll sometimes get a double top with the second leg up or a lower high. And if you want, you can just call it a double top, but I view it as a wedge that did not quite make the new high. If this high went 1 tick above that and we reverse, you'd say, oh yeah, that's an obvious wedge. Well, this is not much different from that, so it's a variation of that, and I would call it a truncated wedge. Another example, here we have a perfect double top, but if it went 1 tick higher and reversed, you'd call it a wedge. And 1 tick, that's not enough to call it something other than a wedge. So I would call it a truncated wedge. It got cut off. The third leg did not go above the second. Another example, third leg formed a double top, but it's basically a wedge. You can call this a double top, or you can call it a truncated wedge. Another version, third leg up, formed a double top instead of a new high, and we got the reversal. Outside down, but can 29 close on its low? I'd get out 2 points below 28, 1 tick below 29 if it closes below its midpoint. And if it closes on its low, you'll probably get more bears willing to short, taking a chance that we're going to have a lower high double top and a swing down. If it's unclear, then it's still on the buy. I don't think you have to get out right here, just a tick below 28, but I would get out a couple points below 28. And if 29 closes below its midpoint, I'd get out below 29. If 29 closes on its low, you'll get swing bears willing to short. But tight trading range since 17, selling in the middle, not very high probability. So I'm not going to short below 29. I think it's okay to get out of longs below a bear bar closing below its midpoint, 29, but it's not bearish enough for me to sell right above the moving average. So will traders buy the close or sell the close? You can always buy the close and get out below 29. I think most traders are better off flat. This does not look like we're going a lot higher. Still on 25 buy, magnet above. Can we break strongly above the high today and rally quickly for a measured move up based on the height of the wedge? Maybe 30% chance of that. So not likely, but we might. If we do get a pair of big bull bars closing on their highs and above 20, then we probably will get a measured move up from here to there. Nothing to sell yet, but not a strong buy. Most traders better off flat, or you could be long, but I would get out below 29. IOI, always in long. Magnet above, but to buy above 20, to buy above 30, you're buying at the top of a trading range, so low probability. So if you buy, you're looking for a swing up. If it goes above 30, we'll probably reach 3,900. But as I said, since bar 2, all of the trading looks like trading range trading. So it looks like a bull leg and a trading range, which means we're probably going to get a swing down for a couple hours at some point. Sometimes we get a midday reversal around 40 or 41, a reversal around 40 or 41. A lot of small bars, a lot of bars going sideways, a lot of bars with tails and small bodies. More likely a trading range, less likely the small pullback bull trend will last all day. I1, magnet above, but the top of a weak channel. So anybody buying has to be hoping for an explosion up like bar 1. And if they don't get it, they'll be quick to get out. They probably will not get it. So anybody buying above 30, you have to be able to make quick decisions. You want bar 1. If you don't get bar 1, it's better to try to scalp out. You can see there's room to 3,900. It's 41 ticks above. Remember, if you buy on a stop, it has to go 42 ticks to make 5 points. So it would have to go at least 1 tick above 3,900 for the bulls to make 5 points. At least 1 tick above 3,900 for the bulls to make 5 points. Reasonable to trade small and add on if it continues up, but it probably will have a hard time getting much above 3,900 if we continue up. Bears will want double top 20 or a wedge slightly above, and the bulls are hoping we get up there. If we do get up there, as I said, this is not behaving the way bull trends typically behave if they last all day. So we should get some kind of a reversal, either here or around bar 40, 41. And maybe we'll get all the way back down here, maybe just to here. That's now 11 bars without a bear body and 11 bar bull microchannel. The bears tried to get a midday reversal, and we got a small wedge, and then the bull trend resumed. We had an outside up bar, 49, forcing traders to buy in the middle of a tight trading range. So the probability is less, and if you buy it, you have to hold for a swing. And then by the time we got 50 or 51, it was by the close, and we've been going up. Probably buyers below 60. So it failed midday reversal. We had a day like this a while ago. We've probably had many like it. This is a good comparison to today. A wedge top, a wedge bull flag, and then a bunch of bull bars. Here it lasted all day, or pretty much all day. And today the rally is starting earlier. Today the rally is starting here. And so I suspect it'll get exhausted before the end of the day. However, I doubt we're going to get much of a reversal. Today looks very similar to this, a wedge, and then a wedge bull flag, and then a series of bull bars. Another attempt at a midday reversal, a couple legs down, bull trend resumed. This is a small pullback bull trend, so you'd expect the midday reversal to fail. Same thing here. It's a wedge, but it's a small pullback bull trend. So you would not expect a major reversal. You'd expect a minor reversal. Same here, small pullback bull trend, minor reversal. A wedge, a couple legs down, but not a reversal, a conversion from a bull trend into a trading range. Of all of these, I think today is most similar to this. We have a wedge, 1, 2, 3, a nested wedge, 1, 2, 3, and then a wedge bull flag, 1, 2, 3. and then after these 3 bull bars closing near their highs, the odds were we were going to go higher. You're going to be wondering about measured move targets. The nearest one would be based upon this leg down. And we're almost there. I think we'll get there. And then you could draw measured move targets from here. We have a higher low double bottom neckline, measured move up, or measured move from here to there, a wedge and a breakout. I don't think we'll go. I think the high of the day will probably be around here. I don't think we'll go a lot higher. It's still a buy for any reason, but a lot of the bulls buying now, like the 60 low, might be switching to scalping instead of swing trading. And for the bears, nothing to sell. We have not had a bear bar in 11 bars. If we get 2 or 3 bear bars, bears might sell, but chances are we're not going to get much of a sell-off. I talked about how earlier this was not behaving the way small pullback bull trends typically behave, and that made it unlikely the small pullback bull trend would last all day. We got a reversal, but now instead of a small pullback bull trend, I would call it an entire day a bull channel. The pullback here is not, the pullbacks are not all that small, here, here, and here. Bulls, reasonable to get out 2 or 3 points below 60. I would not short. The bears are hoping it's a buy climax and that we get a big reversal down. But after 11 bars without a bear body, it's probably not going to go down far. Maybe 2 or 3 bars and that'll be it. You have some scale in bears who sold 38 high, 5 points higher. They're trying to get it below that 38 high. And the bulls know that, so the bulls will buy at and just above that 38 high, betting the bears will not get filled, and then the bears will have to buy back the shorts. Okay, we're right at the 38 high, which is exactly at 3,900. Can the bears get one tick below? That would allow them to get out, break even. If they sold at the 38 high, they get filled here, and they sold more 5 points higher. And now they're trying to get out with 5 points on their second sell and break even on their first sell, but it has to go one tick below the 38 high. Looks like panic profit taking. So it looks like the bulls are taking profits aggressively. 45, the first close all day below the moving average in 45 bars. So I wrote that it was probably going to be by the close. I thought that we might get a second leg down. I thought this might be a complex first leg down and then a lower high and a second leg down. But after 50-51, it became likely that we were going to break above 38. 2, 3 bull bars closing near their highs. That's a change in the character of the market, where we were not getting 3 bull bars closing near their highs all day. We've had tails all day. So the character, the price action had changed. Can you buy 5 points below 60? Can you buy at the 38 high? Probably. Can you buy at the moving average? Probably. But limit order traders will use a wide stop and scale in. This is what happened in this comparable day where we had a wedge top, a midday reversal, and the rally resumed with a lot of bull bars. Instead of going down, we went sideways. We could go down, right? But I think it's more likely minor that we'll go sideways. Over the past month, I've been buying stock, taking quick profits. I'm still long stock, because of, I believe there's not much more to the downside on the daily chart, weekly chart, monthly chart. And I think we're going to get up near the high of the year by the end of the year. And I talked about buying garbage stocks before. Kathy Woods' ARC is a good way to do it. It's a basket of garbage. It's a ETF. This is her ARC star, her ARC ETF. And it's down, 75%. And even if it bounces to this high, up to 70 or so, it'll be 100% gain. And that's the advantage of buying garbage stocks in a bear trend when you think the market may go up. So the stock market might get back to the high, which would be like a 25% gain. But when you buy the garbage stock, it'll be 100% gain. And this is a hodl type of buy. When I buy stuff like this, I don't have a stop. I'm going to buy more lower. So I'm not going to get stopped out. I don't believe it's going to go to zero. And I do believe it's going here and probably back up here within a couple of years. So, I'm very confident, very comfortable being long and buying more lower. I also own individual stocks as well. For the same reason, I've been saying we'd get a sell-off first half of the year and then try to test the high the second half of the year, and I still think that's true. I said I thought the sell-off would last 3 months, and the only thing I was confident about was that we would close the gap on the monthly chart. And over here, there was a gap. You can't see it, but there's a gap here, March, April last year. And I said we should get below 3,900. We may fall to 3,700. And we fell more than that. We fell to almost 3,600. But I did not think we would get here. And I still think we're not getting here. This might not be the final low, but I don't think we're going much lower if we do go lower. And we may have seen the low of the year. So we may have sold off through June and then rally into December. We're not going to go straight up. If this is the rally, we'll probably have a trading range for a period of time at some point. But I keep saying the odds are against it going much lower. Growth stocks, the tech companies, Apple, a higher low and a lot of bull bars. I talked about this earlier. Google, Alphabet, a whole bunch of good-looking reversals. JP Morgan took a big hit, down, whatever that is, 40% or so. I don't think it's going to go much lower, and I do think it'll test this high before the end of the year, and that's a 30% rally in the next 6 months. It may go lower, but I think we're going up there. So there are a whole bunch of stocks. Now, the clowns on TV keep talking about energy, buying energy, and I think that's so stupid. Up here, they were saying energy's going a lot higher. This is ExxonMobil, and I thought that was just such a dumb thing to say. And they were talking about, just a month ago, they were talking about crude oil going up to 160, and I thought that was stupid. I thought big up, big down, big confusion, trading range. The bears will try to get a double top and a measure move down. The bulls will try to get a double bottom and a measure move up. And I just don't think we're going a lot higher. We may stay sideways here, but I think it's sideways or down, not sideways or up. So what do you do here? Bulls, can they buy above 61? It's a buy climax, so we may get a couple legs sideways to down. I'm sorry, can they buy above 62? Also, it's only a doji bar. And for the bears, if they shorted below 61, it's probably a minor reversal down, so it's a scalp. I did not take the short. Too far down from the high, and I thought there'd be buyers around the 38 high. Bears would buy back shorts, and bulls would buy at the moving average. We had 5 or 6 bars below the moving average here, so it would not be a surprise if we went down here, maybe a 50% retracement of that. It's possible we get here, but I don't think we can get there without going sideways and getting some kind of a double top first. So bulls, they get out below 61, and they could buy above 62, or they could wait to see if we go sideways and get a bull bar closing near its high, like 46 or 49. And for the bears, if we get 2 or 3 consecutive big bars closing on the lows, it could become origin short. It was not origin short at all today, and I still don't think it will be. Sometimes you get a buy climax like this, and then you get a bear trend. But more likely, the best the bears will get is a minor reversal in the trading range. You can see the market stalling, starting 56, 55. Tails, smaller bars, sideways bars. So that's some profit taking, and then we have more 61, more 63. And in a situation like that, I'm not shorting. So I did not short above 58, even though I thought we would get profit taking soon. I wasn't sure that we would go down enough to make it worthwhile. Micro double bottom, 62, but to buy 64, the bulls will want a decent sized body and the bar closing near its high. Look at the moving average. Here we got to within 3 or 4 points of it. Here, 2 points. Here we got to it. Here we got 3 bars below it. Here we got 3 bars with their bodies completely below it. So the market's becoming increasingly average as it goes up. And I think that is, it lowers the probability for the bulls buying above 64. We've been getting closer and closer. We're getting more and more involved with the moving average all day. We accelerated up here, good for the bulls, but this may be exhaustion, and we may end up stalling and entering a tight trading range here. I use this as an example. Today, it's earlier in the day. This was later in the day. This is probably around 12:30 or so. Here, the bears got a couple legs on, and the bulls got another new high. And you buy for a scalp, I would not. If you buy 64, I think you're buying for a swing. You're hoping that we either go up quickly, like 1, or relentlessly, like 49, 50, 51. But I suspect that we're going to go sideways more at 50-51. But I suspect that we're going to go sideways more. This is a lot of bars in one direction. And when that happens, it usually takes a long time to resume the trend. It's exhaustive. Let me see if I can find an example where the market just went too far, too fast, too many bars. I know we had an example a few weeks ago. Like this, a whole bunch of bars, very climactic. And sometimes the correction will be deeper and last longer than what you might expect. Bulls trying to get as good a bull bar as they can, micro double bottom at the moving average. But similar to 49, when you get these bigger bars, there's increased risk. Same with 16. So I think it's an okay swing buy. I do not think it's an okay scalp. So if you're buying above 64, you're hoping you're going to get 50, 51, 52, or 16, 17. But you know it's more likely there'll be sellers not too far above and will go more sideways. So a lot of the bulls who buy above 64 will be disappointed by the entry bar or the follow through, and they'll then scalp out, trying to get 5 points. If they can't get 5, they'll try to get 1 or 2. And for the bears, I think there's nothing to short. I did not short below 61. I would not short below 64. This is one of those days that might stay always in long all day. So far, consecutive inside bars, so I. After a buy climax, if this was up here at 61, I would consider selling if it went below. But we've already gone down a little bit, and I think it'll probably be a minor reversal. So I'm not looking to sell below 65. If it remains an inside bar, it's still a buy above 64, looking for at least a minor new high. Very often, when you get, well, half the time, when you get an II, you'll get a failed breakout. So it'll go above and then below, or below and then above. So II, if it was at the top, I would sell for a possible swing down, but it's too far below the high. So it's still a buy above 64. Bulls hoping we get up here, but tight trading range. So increased chance sellers above. If you buy, the stop typically is below the lower of the 2 bar 64. In this case, I would put it below 63. And if you sell below 65, I would exit above 64. 64 is a credible buy. II's breakout mode. Breakout mode, 50% chance we go up or at least a measured move based upon the height of the pattern. 50% chance we go down. 50% chance the first breakout up or down will fail. That's in general, but this is coming in a bull trend. So the odds are higher that we'll get a successful bull breakout. Is it 60%? No. We would not be doing this if there was a 60% chance that we would go up. But it's better than 55%. And if we break below 65, it's less than 50% that will go down. Can the bulls break out of the tight trading range and get a new high? Or will this be a lower high and then more sideways? The bears, I think, need to do more before many traders will sell with stops. There are bears selling with limit orders above 64 because it's basically 50-50 that it's going to go up, 50-50 that it will reverse. So it's good for limit order bears, and it's good for stop order bulls looking for a swing, but it's not good for stop order bears below 65. I don't think the probability is high enough. Remember, 50-50 chance this breakout is going to fail and will go below the II. Are bulls sufficiently disappointed that 66 was not bigger so that they'll scalp out? They might. They wanted a bar that looks like 1 or 16 or 17. And they got a bull bar closing near its high, but it's not all that big. So, and then it did not yet break above 60. So you might get some disappointed bulls scalping out with a couple of points. The bears want a double top and a reversal down, but they'll need a good-sized bear bar closing near its low to attract many sellers. Should the bulls get out with 5 points? I think that's reasonable, right? Bears made money selling above 38. They probably will sell the 60 high and sell more 5 points higher, 10 points higher. Bulls, do they get out below 67, double top 60, wedge 38, 60? They can get out maybe a couple points below 67. And bears, I would not short. Unless you're willing to sell with limit orders 60 high and scale in higher. But I would not do it. This is an impressive rally. And I think if I'm right that the market is going to go up over the next 6 months, at some point, all those bears who have been saying no are going to have to buy. And we could start to get rallies into the closes of days. When you look at a chart, daily chart, and when you see this, does that mean the market opened here and it rallied all day and closed there? No, it means it opened here and closed there, but it may have been sideways all day. What it means is bulls bought at the end of the day. They bought end of the day. They bought end of the day. It does not mean the market traded up all day. So when the market is in a bull trend, traders tend to buy going into the close of the bar. And the result is you get a lot of bars closing near their highs, closing near their highs. A lot of bars closing near their highs. These were not all bull trend days. A lot of them were trading range days, and they closed near their highs because bulls bought into the close of the bar, deciding that the market was going to go higher tomorrow. So if this is the start of a bull trend, you'll get more and more traders buying right in the final hour, final half hour, final 20 minutes, betting that tomorrow will be higher. And therefore, there's an increased chance that we could get a surprisingly big move going into the close. Do I think it'll happen? No, but it can. Because of where we are on the daily, weekly, and monthly charts, we're at a price where I thought the market would bottom back in January and December. I said 3,700 to 3,900, and we've been below 3,900 for a couple of weeks, but we're not really going down much more. So we're in my buy zone. Wedge 38, 60. Can you sell 68? If it looks like 38, yes. But if it looks like 6, then no. So the more it's a bear bar, the more it's a big bear bar, the more it closes on its low, the more traders will be willing to sell. You have the limit order bears who sold the 60 high. They have limit orders to sell more higher, maybe 5 points higher, maybe just 2 or 3 points higher because the bars are getting smaller. Bulls, there's always a chance of a collapse. It's a small chance, but it's enough so that if you're long, I would get out maybe 2 points below a bull bar 68. And for the bears, I don't see anything that I want to sell. We got 3 more consecutive bull bars that will reduce the number of bears willing to sell below 69. Remember, I thought we were going to get to this measured move, which is a little bit higher. We don't have any other nearby resistance until up here. 15-minute chart. Last week's high. And then the top of that gap that I said we should close. I don't know that we'll close it tomorrow. but I do think we'll close that gap on the daily chart. That's that big gap. We had two big gaps down here. I said we should close both. We closed one here and pulled back, and I think we'll close that and get up here over the next couple of weeks. It could be really interesting. We could accelerate up. We collapsed down, and so you have a lot of traders who are short here, and they're worried that it did not continue down, so they'll have to buy back their shorts. And then all the bulls who've been listening to the idiots on TV are not buying. And if it starts to go up at some point, they're going to say, the TV guys are stupid and I got to buy. And that could lead to an acceleration up over the next week or two. The bulls have more than 5 points, so reasonable to take some profits. And also we're at the measured move target, reasonable to take some profits. Can you short and scale in higher? I would not do it, because of the possibility of a squeeze, a short squeeze from people on the daily chart and weekly chart and monthly chart. The first 6 months of the year was the biggest drop in the first half of the year in a long, long time. And that makes it less likely that we were going to continue down strongly in the second half of the year. So when you see those people on TV saying we're going down 40% or more, there's just idiots with titles, chief economic this or vice president of that. But they just want to be on TV and get attention. When you say low probability things, you're going to be wrong most of the time. And I don't like TV giving those people airtime, because I think it hurts the general public. When you put these people on, they wear suits, they look impressive, they work for big firms, they have impressive titles, but what they say, if you listen to what they say, you look at the charts and say, I don't see it, that doesn't make sense. And you're right, they're wrong. It doesn't make sense what they're saying. But because they have a title and they look good and they sound convincing, they're on TV. But because they have a title and they look good and they sound convincing, they're on TV. I think if this does continue up next week, all of a sudden you won't see the bears anymore. All you'll see are bulls saying it looks like we're going to rally into the second half of the year and maybe test the January high. We're above that measured move, so next would be a measured move possibly based on that, which is around where we are. And then finally, possibly a measured move based upon the wedge. And there's still enough time to get there. I don't think we will, but we might get there. If this trend in here was stronger, then I think the bulls would have a decent chance of getting there. It's been good here so far in the second half of the day. Well, we had a lot of two-sided trading early on. Big bar 69. When you get a bigger bar late in the trend, it attracts profit takers. And we've been rallying now for 20 bars, and this is the biggest bull bar among the 20 bars. So that will attract some profit takers. Also, the bulls who bought 64 and make 10 points. A round number, which they like. So you might get some profit taking here. Can you short 70? If it looks like 38, I don't think it'll look like 38. If it does, I would get out of longs for sure. I would get out of longs below any bear bar closing below its midpoint. But to short, in the past 20 bars, we've had 3 bear bars. So, how eager are traders to short? We've had 20 bars with only 3 bear bodies. Do you think that's a good idea to sell? I don't think so. That's relentless buying. You get out of longs 2 or 3 points below 70, but I would not short. Now, I said tomorrow the unemployment report comes out 5:30 before the market opens. Let's say the unemployment report is good. Let's say there were a lot of jobs created. Won't that make the Fed want to raise interest rates more and faster? Yes. Yes, but it also means the economy is strong. So just because the Fed is going to raise more does not mean the market has to go down. So you can get a very bullish report, which means the Fed will raise rates more and the stock market could still go up. Let's say, on the other hand, there's a loss of 100,000 jobs, a bad unemployment report. Can the market go up or down? Yeah. It could go up because traders will say, the Fed's done raising rates, so we know that there's a floor in the bond market, and we're probably, so you don't have to worry about rates going up and up and up, and therefore the stock market can go up. So, and you can also argue a bad unemployment report means the economy is bad, so yeah, the Fed may not raise rates as much, but the economy is bad, and therefore the market can go down. I talk about this every now and then, that no matter what an economic report says, there's a bullish interpretation and a bearish interpretation. And whether the report itself is bullish or bearish, if the market goes up, TV will only put on a bull. If the market goes down, TV will only put on a bear, and that bear will explain why the market went down. As I said, if it's a good unemployment report, he'll say, the market went down because the Fed has to raise rates. If it's a bad unemployment report, he'll say, the market went down because the economy is clearly slowing and earnings are going to be less. So it's all a game, and never pay attention to the guys on TV. Especially if they say something that does not make sense. You look at the chart and you see one thing, and they say something else. Turn on I Love Lucy. You're wasting your time listening to a fool. And I do think most of the people on TV are fools. What happens is they get in front of a camera and they know they have to exaggerate. So they'll believe that something might be 50-50, but they'll make it sound like it's 90%. And I think that is bad for the viewers, because most of the viewers don't have enough experience to know that the guy is just exaggerating, because he's on TV. And so I say they're fools. Maybe there's a better word for it, but they're not doing a service. They're not providing a service to the viewers because they're exaggerating. Buy climax again. I'd get out a couple points below any bar. I'd get out one tick below a bear bar closing near its low. And possible high today, we could collapse, but it's unlikely. So it's a low probability sell below 71. So I'm not going to take it. The rally to 60, strong enough to expect at least one more leg up. We have one more leg up, but this rally is strong enough to expect one more leg up. So the odds are we're going to get one more leg up, even if we pull back for a few bars. Very strong trend since the middle of the day, 49. So, I'll let somebody else make all the money shorting. I'm not going to do it. Now, limit order bulls, they might buy the 70 low. It's like buying the 60 low. You buy the 60 low, you try to buy more lower. If it doesn't go low enough, then you buy the reversal up, 64. Same thing here. And for the bears, it's just too strong for me to short. Well, it's too strong for me to short with a stop order. If we get 3 bear bars, I might sell above the high of a bear bar. But if it's an II like 65, even though it's a bear bar, the first of the 2 bars was a bull bar, 64. So I want to buy above 64. So reasonable to exit longs, and it's reasonable to sell, but it's a low probability bet, and it's too low. It's less than 40% chance that we're going to get a swing down. So I'm going to wait. If we get 2 bear bars closing near their lows, consecutive bear bars, especially big bear bars, then we'll probably get down to the 63 low. But moving average support all day. So I think the market will have a hard time getting much below the moving average. And if it does, let's say we get 5 big bear bars and let's say I don't short, who cares, right? I miss trades all the time. I probably see 50 reasonable trades a day. And I don't take 50 trades a day. I take 10, sometimes 20, sometimes fewer. So that means most of the trades I see, I don't take. And I never feel bad about missing trades. And sometimes I miss some really good trades where there was a lot of profit. But, again, I know there's always going to be another trade. 35 years ago, I used to worry if the market was trending strongly for a couple of weeks and then it goes into a trading range for a few days. I seriously would worry that it might stay in a trading range forever because I didn't understand how markets operate. They constantly do look for every possible thing that they can do, and they'll do it. And they'll just keep recycling trends, and trading ranges, strong trends and weak trends and reversals. The market is constantly balanced. Bulls and bears, sometimes one side has a little bit of an edge, but the edge is never all that big. And sometimes the limit order traders, the trading range traders make money. Other times the stop order traders, the trend traders make money. Sometimes they both make money. But I never worry about missing a great trade because I know there'll be another great trade. So, I just, stuff happens also, I sometimes have a contractor over at the house, or my kids might be visiting, or, who knows what, somebody might be sick, I may have a doctor's appointment coming up. So there are a whole bunch of things that, life happens, and sometimes you simply cannot take trades because you're distracted or you don't have enough time for the trade to play out. You have to go do something 30 minutes from now, but you're looking for a swing that might last a couple hours. And, I only worry about the trades I take. Is the trade sensible? Am I doing something reasonable when I enter the trade? Do I have a good plan? Is my expectation reasonable? Am I managing the trade appropriately? That's all I care about. And if I do something stupid, or taking a trade that I think is bad, I immediately get out. And if I lose a couple of points, I don't care. If I did something stupid, I got to get out. And, not hope that it becomes smart. If it's stupid, it's probably going to become stupider. So I just get out and take the loss. It's very easy to make a mistake and have a small loss. And because you don't want to take any loss, you wait. And the small loss becomes huge. You cannot do that. When you think you're wrong, just get out, take the loss. And only care about things that you're doing, not things that you didn't do. If you miss a trade, maybe you're tired, maybe you have a headache, who knows what. That's okay. Maybe you were distracted. That's okay. If there's a later entry, you can take the later entry. And, you'll learn from the pattern, and maybe you'll see the pattern again sometime soon. And next time when it starts to set up, you'll be ready for it. And then you'll take it next time. But never be hard on yourself. That's everybody else's job. Your job is to advocate for yourself. Be positive. Look for the good things that you do. Try to avoid stupid things. But never get mad at yourself. Never think that you're a failure, that you're a horrible person, that that you really screwed up bad. As I said, that's everybody else's job. Your job is to be your advocate. Look to build up your confidence and look for the good things that you do and be happy that you did them. Limit order bears 60 high. They're trying to make their money. Some bears sold the 60 high, sold more 5 points higher. I did not. 71 outside down, closing on its low. Reasonable short, I did not take it because too many bull bars, and we're late in the day, and when the market is rallying fairly strongly for a few hours like this, it usually is not going to reverse down sharply. With the unemployment report tomorrow, there's a higher chance that it could reverse down sharply, that we overdid it on the upside possibly. I'm going to get rid of this measured move. But too many bull bars here and here, and that makes me not want to short. 72, it's a multiple of 3. It corresponds to a 15-minute bar. And if you look at the 15-minute chart, you have a bear bar, but it's a small pullback bull trend. So even though it's a bear bar, all the pullbacks are small. 1 bar, 1 bar, 2 or 3 little bars, 1 bar. How much profit do you think you'll make selling below that bar? I don't think it's worth it. It's a high 1 above 72, but it's consecutive bear bars. So there might be more sellers than buyers above 72. So we have a buy climax top. You can argue wedge 38, 60, 71. A good sell signal bar, but too many bull bars. So I don't want to short. The bears who did short, do they get out above 73? If it's a bull bar closing near its high, they can get out above 73. Otherwise, they get out above 71. Can they scale in higher and sell more? Well, that's a problem because we're late in the day. Now, it's hard to see, but the 72 low is exactly at the 60 high. And I talked about this earlier. If you have a limit order bear who sold 5 points above 60, he needs it to fall 1 tick below 60 to get out with 5 points. And I said if you did scale in and it gets close to your target, here it hit exactly the 60 high. It did not go 1 tick below. Most of those bears were unable to buy back their shorts with the 5-point profit. And if it starts to go up 73, a lot of those bears will buy back their shorts, panicking, thinking, darn, I hit my target, and now it's going back to my entry price and late in the day. I don't want to continue to hold short. I'm going to buy back my shorts. So for the bulls, high 172, I would not buy above. If 73 closes on its high, you might get some bulls buying because they know the bears who sold 5 points above 60, if they did not get out during 73, they're going to get out above 73 if it's a bull bar closing near its high. Musical shares, right? When is the bull trend going to convert into a trading range? I do not think it's going to convert into a bear trend today, but it could simply start to do this. It may start to go back to this kind of trading, instead of this kind of trading. That's the best pair of bear bars that we've had all day, right? Good-sized bodies closing near their lows. So that's the strongest brief sell-off all day. And that will increase the number of bears willing to sell above 72, above 71. I'm not going to do it this late in the day. And it will reduce the number of bulls buying above 73, especially if 73 has a fairly conspicuous tail. If it has a 2-point tail on top, or even a 1-point tail on top, I think fewer bulls will take the buy because that's the most bearish thing the bears did all day. The bears are going to sell the close of 73. Why? Because they don't want 74 to go above 73. They don't want a buy signal to trigger because then all the limit order bears who sold 5 points above 60 will exit. So the bears are going to sell the close of 73 because they don't want the market to go above a bull bar 73. You see that all the time. 18, a bear bar, but after 2 good bull bars, they bought the close. So, conspicuous tail on top, 5 ticks. That will reduce the number of bulls buying above 73. if I were short, I'm not. If I were short, I'd buy back my shorts. If it was, if we had a couple hours left in the day, I might not. I might sell more above 71. One thing that often happens is if the market gets down to the prior high but not below it, and we get a new high, it'll usually pull back below that high. So if we go above 71, we'll probably pull back below 71. So the limit order bears almost made money here. If we go to a new high, they probably will make money selling the 71 high. They made money selling 5 points above 38. They made money selling the 20 high. They made money selling the 5 high. The only time they did not make money was selling the 60 high and 5 points higher. But if we go above 70, I think there'll be sellers above. They might be right at the 71 high, or they might be at the 71 high and then sell more 5 points higher. So because of the consecutive bear bars, the best pair of bear bars all day, I did not buy 73. Also, it did not reach the moving average. 25, 46, 49, 64. We reached the moving average on all of them. Here we have the best pair of bear bars all day, and we did not reach the moving average. That doesn't sound right. So we probably have to get down to the moving average. 41, 4 bear bars, and then a good bull bar, 42, they sold the high. Here, the best pair of bear bars all day, and they sold the 73 high. Nobody wanted to buy it because of what I said. We probably had to drop to the moving average after those 2 bear bars. Bulls giving up, and they might give up for the remainder of the day. Can you sell the market? The 72 low? I'm not going to. I might be trapped out here. Remember, tomorrow's unemployment report is an important report. It could lead to a huge move in either direction. So I can see the market pulling back, trying to get a little bit more neutral ahead of the report. I can see the market pulling back, trying to get a little bit more neutral ahead of the report. Moving average, they bought it all day. Big outside down bar closing near its low, a surprise bar down. And then maybe we'll get to the 63 low. The bears would like to retrace the entire rally to 49, but I think that's unlikely. I'm flat. I'm not selling the market. I'm not selling the close. Will I buy 75? Probably not. I think it's a big enough move down to create confusion. Big up, big down, and we'll probably go sideways. I talked about over here, climactic and sideways, and this is similar to that day, climactic, a little bit sideways, more climactic. So I suspect we're going to be sideways until the end of the day. Bears are disappointed by weak follow-through, and the bulls are disappointed by a surprise bar down and a bull doji bar. So increases the chances that not many bulls are going to buy above 75 despite the high 2, and not many bears are going to sell below 75 despite the low 1, what they hope is a bear trend reversal. Probably better to wait for tomorrow. Right now, I'm not planning to take any more trades. Bulls trying to get the day to close on its high, but I think 3 decent sized bear bars, most bulls are not going to buy above 75. Moving average, they've been buying it all day. And for the bears, if they were short, I would get out of shorts here. I thought there might be sellers above 73. I thought we had to reach the moving average. But I'm not confident at all that there are sellers above 75 or at the moving average in a day where we found support at the moving average all day. Big up, big down, big confusion. Sideways 3 bars, sideways 3 bars. Tails becoming more prominent. So we're starting to look like this again. More limit order sideways trading. Late in the day, not many bars left. So the potential reward is small. Outside up, a lot of computers see this as a limit order market. So there may be more computers selling above 76 than buying. The high 2 at the moving average is good for the bulls. It's probably a wedge on a smaller time frame chart. Down on 72, up on 73. Down on 74, up on 75. Down on 76. Bulls are hoping it's similar to the wedge here, but it's not. This is more intense selling, and 76 has a prominent tail. 49 did not. 49 closed on the high. Did not become always in short at any point today. It's been always in long right from the first bar. What do the bulls do if they bought above 75 or 76? One of the difficulties with stop entry trades late in the day is time. Most of the time you're looking for a reward that's twice your risk. But 76 is relatively big, so your risk is relatively big, and it makes it hard to make twice your risk. It's still on the buy above 76, stop below 76. I'm flat. The bears are hoping for a low 177, but it looks like we're holding the moving average, so the probability is low for the bears selling below 77. Do the bulls get out below a bear bar 77 or below 76? Because there's not much difference between the two, if I were long, I'm not, I would get out below 76. Might get 77 outside down after outside up. Outside down, I know 77 low is at the 76 low, not below, or just went below. But even if it's just at the low, I still call it outside down. So outside down, we had inside 64 and or 65. Now we have outside 76, 77, right around the same price as the II 65. Breakout mode, so theoretically a sell below, a buy above, and you're looking for a measured move, but that's about 15 points, and it's unlikely you're going to get a measured move. So low probability that you'll make 15 points buying above 77 or selling below 77. I would just wait for tomorrow. One of my guidelines is if it's sideways for 4 bars at 12:45 or later, I don't do any stop order trading. And this is sideways for 4 bars at 12:45 or later. So I would just wait for tomorrow. I'm going to let it go. For the bulls, it's another higher low pullback to the moving average, and we have an 00. But there's no time left, and sideways for a lot of bars. So I'll let it go. You know, maybe 25% chance we'll get 3 big bull bars out of this, and it's not worth it for me. Good day for the bulls. For the first half of the day, we had a spike pullback channel and a small pullback bull trend, but too many bear bars and too much overlap. And I said I did not think it could last all day. we tried to get a midday bear trend reversal, and then the bulls reversed up from the moving average, 49, with those three bull bars, 50, 49, 50, 51. Very little overlap, closing on their highs, different from everything else that took place today. First time all day, three consecutive bull bars closing near their highs. So it looks like the character of the day is changing. So by the close, and then we had, I think 11 or 12 bars up to 60. I guess it's 12 bars without a bear body. That made it unlikely that we would get much of a reversal. Down to the moving average, we had an II of 65, and they've been buying the moving average all day. I thought we'd go at least a little higher. This is so strong, we should get at least a second leg up. And we did. Now we got the blow-off bar 69. Bulls took profits. The ones who did not take profits on 70 after seeing 69 exited 71, 72. The bears hoped that we would get a swing down, but I think it's really difficult to hold short. I think you could hold short above 73, but I personally, if I were short, I'd get out above 76 and not sell below 77 or 78. On the open, we had a big bull bar closing near its high, and the context was good for the bulls. We had a good rally yesterday. FOMC minutes, we rallied. We've been rallying for a few days. And on the daily chart coming in today, we had 4 consecutive bull days. And now today we have 5. So the context was good for the bulls. And we had a big bull bar closing near its high on bar 1. We could either buy the close or buy above 1, or wait to see if 2 has a bull body and then buy the close of 2. And look at 3, the open of 3. As soon as 2 closed, a whole bunch of computers bought the market. And that's why the open of 3 is above the close of 2. There were so many buy the market orders. But 2 tail, 3 tail, 4 closing on its high, but not all that big. I think we'll get a pullback, maybe to yesterday's high, maybe a 50% pullback. And 6 consecutive bear dojis, 6 bar bull microchannel, probably a minor reversal down, testing yesterday's high. Very good bear bar 7, but bad follow through 8. 8, I think we might get a second leg sideways to down after 7. So I don't think you have to buy above 8. The bears got upside down 10, but then tail and bull bar 11. Bull bar closing near its high. You could call it a high 2, a higher low double bottom, but you could also call it a wedge with 5 or 6 as the first leg down. So, on a smaller time frame chart, it's a micro wedge, down on 6, up on 6, down on 7, up on 7, down on 8, up on 8, and then a pullback to a higher low 11. Buying above 11 made sense. 12, a little bit disappointing that it was not bigger. 14, a low 2, 9, a lower high major trend reversal. The 3 pretty good bull bars. I would not take the short. Outside up 16, closing on its high, but it might be a wedge with 10 and 14. So if you buy above 16 or above 14, you're buying for a swing. And then you get 18, disappointment. I would get out of longs below 18. Did not go below 18. 16 and 17, enough of a bull surprise. Consecutive big bull bars closing on their highs. We should get at least a second leg up. But that means there might be sellers above 18 or 19 because that would be a second leg up. And there were 20. So 20, you can call it consecutive low 2s. You can call it a wedge. 14, 17. I thought of it as consecutive low 2s. Low 1, 9, low 2, 14, and then a breakout above the low 2, and then an attempt down 18, and then a second reversal 20. But a tight bull channel, 8. So I thought it was a small pullback bull trend and a minor reversal. You sell below 20 and you hope for a collapse, and then you're disappointed in 21, 22, and you switch trying to get out with maybe 5 points. 24, a low 1, and what the bears hope is the start of a bear trend, but 5 bear bars right above the moving average, so not worth shorting. And then 25 I thought was interesting. It's a type of wedge, 23 legs down, 21, 23. a bull bar closing near its high and touching the moving average, but it didn't touch the moving average. I'll talk about that in a second. However, it's a credible wedge bull flag. We might go sideways, might go up, but if we go above 20, we'll probably try to get a wedge in a midday reversal, which we got at 38.39. When you zoom in on 25, can you see the low of 25 is below the moving average? Well, I talked about it when it was happening. 25 never touched the moving average, yet its low is below the moving average. So how is it possible that the low is below the moving average, but it never fell down to the moving average? Because at one point, it was a bear bar, and the low of the bear bar was above the moving average. And then it became a bull bar. The average is calculated based upon the close of the bar, and the close of the bar pulled the average up below the low of the bar. So when you look at it and say, yeah, it touched the moving average, but it did not. It did not. It never touched the moving average there. But if you're running computer testing, your computer will say, in fact, that it did touch the moving average there. So a 20 gap bar buy, a gap between the moving average and the low of 24, and more than 20 bars with gaps. And that means bulls have been willing to pay an above average price for 20 bars, 24 bars. And a lot of bulls will be very happy to finally buy at the moving average. So if they buy above 25, the bears tried outside down and a truncated wedge 29, a lower high double top 20, but a 4-bar bull microchannel. I don't want to sell below the 29, especially with that tail. IOI 30, but 4 sideways bars and possible double top 20, possible wedge with 5 and 20. If you buy above 30, you're buying for a swing. Outside down 32, but tail, small pullback bull trend. I think it's reasonable to exit long below 32. You don't have to. You could keep a stop below 29. In bulls, if you're trading always in, 34, bull bar closing near its high. If you get out below 32, you buy again above 34. Disappointment 36, I would get out below 38. And it's a reasonable short. We should get a couple legs sideways to down. We have a wedge, 5, 20. We have a bear bar closing near its low, and we have a second bar closing on its low, 39. So we should get at least a couple legs sideways to down and below the moving average. Maybe it'll have half as many bars as there were in the wedge. So the wedge had about 38 bars, so maybe we'll get 15 or 20 bars down. Instead, we only got about 10 bars down. 3 or 4 bear bars, 41, probably sellers above. Outside up, 42, it looks like 25, pull back to the moving average. But 4 bear bars and a wedge, probably sellers above. Lower high, 43, but I'm not confident we're going a lot lower. It's a small pullback bull trend up to 38, and this is probably a minor reversal. So if you sell below 38, you hope for a collapse. You got a bear surprise 45, but terrible follow through 46. Had I sold below 43, I did not. I would exit above 46. But a bear surprise 45 lowers the probability for the bulls buying above 46. So if you buy above 46, I would use a wide stop, maybe just below 25 or a few points below 25. Low one, 47, but a tail and one more leg down would be a wedge bull flag. So I don't want to sell below 47, 48. I'll set up 49 at the moving average, close above the moving average, micro double bottom, 45, 49. We may go up here. We may simply go sideways. You can either buy above 49 or wait for follow through 50 and buy the close or buy the market. And then 51, you get 3 bull bars closing near their highs, 2 of the bars closing on their highs. We're going higher. So it's probably going to be a failed midday bear trend reversal. 38, 39, just about the middle of the day. 81 bars to the day. In the middle of the day is 40, 41. But sometimes you'll get a midday reversal, a few bars before, a few bars after. 51, it looks like a failed midday reversal. So we're probably going about 38, maybe up for some kind of a measured move. So buy the close 51, 53, 54, 55, you can buy the close, but big tail. So I'm less willing to buy above 58. It's a high one, but at this point we've had a 9-bar bull microchannel and 9 bars without a bear body. So we're probably going to get profit taking soon. 60, 12 bars without a bear body. Relentless buying, 12-bar bull microchannel. Probably only a minor reversal. I would not sell below 60. I'd get out of longs, maybe a couple points below 60 or one tick below 61, and then wait for the next bull bar and buy again. Bears got a second bear bar 63, and then we had II 67. I said I thought the odds were we would go up, and I thought if it went down, it probably would fail. 66 broke above the II 64, but not all that big as a tail. I think we'll go above 60, and then 67 consecutive bull bars closing near their highs. So it's buy the close again. And then 69, the biggest bull bar since the bull trend began, 49. So when you get a big bull bar, I know it's not all that big compared to all the other bars today, but compared to the bars in this rally, it's the biggest one. And that will attract profit takers. We expected a second leg up after 60. This is a second leg up. So some bulls will sell the market on the close of 69 instead of buy the close. And others will wait for a bear bar and exit below bear bar 71. Possible high of the day, but 5 decent bull bars here. I think it's probably a minor reversal. And then consecutive decent bear bars 71, 72. The best pair of bear bars all day. We're probably going lower, maybe a couple legs down. So 73, I would not buy above. There probably are sellers above, especially with the tail. And outside down 74, good for the bears, but at the moving average. And then bull bar 75, bad follow through. I would just wait. So for stop entry traders today, they could buy above 1, and I would not buy above 4 because it follows 2 bars with tails. You could buy above 8, a 50% pullback, a test of yesterday's high. But enough of a bear surprise plus 3 consecutive bear bars. I would rather wait for a second leg down and a better bull bar, which we got 11. So you buy above 11, buy above 12. 13, you could buy above, but I think it's a trading range open. If you buy above, stop below 11. Reasonable to get out below 14 or 15. You could buy again above 16. Bad follow through 18. Third leg up. I don't want to buy above 19. You could sell below 20. Probably a minor reversal. I would exit shorts and get long above 25. You could buy above 28, above 30, above 31. You can get out below 31 and buy again above 34. But bear inside bar 35, I don't know. Buying above 34 at this point, not great. Bull breakout 37. Can the bulls get follow through? Instead, we got a reversal. We got a wedge. And in the middle of the day, so midday reversal. I would go short below 38 or 39. Outside up 42, the bulls are trying to be like 25, but a wedge, midday reversal, we should get at least a second leg down. So probably sellers above 42. If you get out of shorts above 42, I don't think you have to. I'd keep the stop above 38. But if you do, you can always sell again below 43. Bear breakout 45. First close below the moving average all day. 45 bars into the day. Traders are going to buy the close. Probably more traders will buy the close than sell the close. So I would not take that sell. And 46, you could buy at a high 242, but I think we'll get more bars down after a 38 bar wedge. I would not sell below 47 because the third leg down, it could be a wedge. And then if you bought above 46, I would use a wide stop. Outside up 50, outside up 49, closing on its high, but a tight bear channel, and we may get a lower high and a second leg down. So only buy if you're swinging and buy about 50, 51, 53, probably 54. And then we're stalling up there, 56, 57. Plus we're getting too many bars without a pullback. So I would rather buy a pullback. You could buy above 56 and then above 58. But I would be quick to get out maybe a couple points below a bull bar 60 or a tick below bear bar 61, and then buy again above the 64, II 66, 67, 68, and then that bigger bar 69 I would exit. And if you want, you could sell below 71. Limit order bears made money all day, which is interesting. It's a bull trend, but at every new high, bears sold and sold more higher, and they made money. We got a reversal back below the prior high. Even here, after all this, the bears made money. They sold that high, got filled here, sold more 5 points higher. We got back here, they got off break even on their first sell right here, and 5 points there. And even with this breakout, they still sold. So something's odd about the rally. Here we got a bull channel, and it never became always in short, yet the bears made money selling new highs all day. Can you buy the 6 low? If you put a stop below 1, you could. You could buy the 9 low, stop below 1, on the 13 low, the 28 low for sure, probably the 31 low, and 60 low, but I would use the wide stop and scale in, and 70 low I would not buy. And then what about selling above a bear bar 14 or 15? You could, but with those 3 bull bars 13, I would not. 18, possible wedge. So some bears would sell above 18. They would sell above 21. And they might start to sell above 33, 35, but it's a small pullback bull trend. I would rather sell on the stop below 39. You could probably sell above 41. You'd get filled 42. You could either exit above 42 or keep a stop above 38. Had I sold with the limit order 41, and I saw a bull bar closing on its high here, with the 4 bear bars and the wedge, I would hold short, stop above 38. And then traders bought below stuff. They bought below 18. They bought below 42. They bought below 46. Here, can you sell the 65 high and scale in? I would not, because it's a bull flag at the moving average. And 72, probably sellers above. Tomorrow's unemployment report is at 5:30, and it could lead to a big move up or down. And if it leads to a big move up, we can open with a big gap up, possibly even above this high, and then quickly close that gap and get up here next week. It's still possible we could get a surprisingly big move down. We could open below today's low. Today is not a very big day. So I would be open for anything. But as you know, I think if we go below the June low, there'll be buyers below. And I think we're going up here. And by the end of the year, I think we're going up here, possibly all the way to the January high. But I think by the end of the year, we're going up in this area. I just don't know if this is the final low or if we get one more new low, and that'll be the final low. I would like one more new low. Then we'd have consecutive wedges. Go wedge 1, 2, 3, bear breakout, and then wedge 1, 2, and 3. So if we got one more new low and a reversal, that would be a higher probability low for the year. But it's possible that this is just a collapse, a bear climate, a sell climax, and the end of the selling. We'll know tomorrow or over the next few days. If we start to get this, then this is probably going to be the low for the year. I want to say one other thing. If you were watching the talk shows over the past couple of months, you'd hear everybody, all the experts saying, "Oh, you got to buy gold. You got to buy gold. It's always good to buy gold." And I'm thinking, what? That's stupid. Why would you want to buy gold? When you got a big reversal down, why do you want to buy gold? It's dumb. Weekly chart, lower high double top. Monthly chart, double top, big triangle. When I hear that, there are some people who go to the church of gold, and gold is their god. If gold is going up, it's a buy because gold is going to go higher. If gold is going down, it's a buy because now it's cheap. when do you sell gold? Well, you never sell gold because it's always going to go up. That's what they believe, and it's just stupid. When people on television were saying, "Oh, gold's a buy," and here they're saying gold's a buy. To me, that's just stupid. Bitcoin. If you've been listening to me for any length of time, I have a psychological issue with Bitcoin. There's a song by Nielsen, I don't know, probably 50 years ago called "The Land of Point," about a guy with a round head and everybody else had a point. Bitcoin, to me, has a round head. It's pointless. There's no reason for it to exist. And that's my fundamental problem with Bitcoin. It's never going to be a store of value. When gold was going up, Bitcoin was going down. And it's never going to be a currency. Because of the way Bitcoin is structured, you can only do 7 transactions a second worldwide. Visa and MasterCard can do thousands of transactions a second. So why buy Bitcoin? Well, because some rich guys on TV say, buy Bitcoin. That's the only reason to buy Bitcoin. Other than that, there's no reason. And I think the government needs to crack down because it's still a currency for thieves. The government can trace just about any Bitcoin transaction, but there are so many thieves trading, laundering money through Bitcoin, the government can't track them down. And I think they don't want to look at any thief who's trading less than $1 million or so. So, so most of the thieves are just getting away with it. But, also, you can say, well, it's a trading vehicle. Well, it is. Here's Bitcoin, and here's the NASDAQ. They kind of look the same, don't they? NASDAQ, Bitcoin. So I don't want to trade Bitcoin, which has the possibility of going to zero. I'd rather trade the NASDAQ, which has no probability of going to zero. And you can say, well, Bitcoin has far greater leverage. That's true, but you can buy it. So here, we fell 70%. You could buy levered ETFs for the NASDAQ. Here's the TQQQ. And that also fell about 70%. And since the NASDAQ is not going to zero, it's a safer thing to trade, and it has the same beta, the same amount of movement that Bitcoin has. So as you can tell, I have traded Bitcoin. I'm still willing to trade it, but I'm not willing to buy it at 20,000 and maybe at 10,000 if it gets there. But I really don't see any reason for it to exist. I understand you get all these. By the way, the Bitcoin religion people on TV, used to say it's a storage of value like gold, and then they said that for years. And then when it went down, when gold was going up, they no longer say that. And they used to say, well, eventually everyone is going to be transacting in Bitcoin instead of Visa. Well, that's not going to happen because it cannot handle enough transactions. And you have the problem of the bid-ask spread. It's too big. When you want to buy, you have to buy too high. When you want to sell, you have to sell too low. So, I think Bitcoin has a lot of work to do before it will convince me that it has a reason to exist. What about Ethereum? They're all the same. Ethereum, you can do more transactions per second, but it's still a round head in the land of points. It does not have a point. Question: you suggest selling 5 points below a bull bar or 1 tick below a bear bar, closing below its midpoint. I suggest exiting longs 5 points below a bull bar when the market's in a fairly strong trend. Okay, back to the question. Is this valid in swing trading as well? Can you comment on why not to exit 1 tick below both a bull and a bear bar, or 5 points below both bull and a bear bar? If the market's in a really strong trend and there's a reason to expect profit taking 2 or 3 legs down, I'll get out below a bear bar. If the market is in a small pullback bull trend, especially if it's lasted only 10 bars or 15 bars, I'm not going to sell below a bear bar. I'm going to buy below a bear bar. So early in a small pullback bull trend that I think could go a lot further, if we just got a good reversal, this kind of a thing. Am I going to sell below this? No, I think we're going up. Am I going to sell below this? No, I think we're going up. But I might sell below that possible wedge. I think it's going to be a minor reversal. The channel is tight. But if it's a strong reversal, and I think it's going to last at least a couple hours, I don't want to be exiting or selling. And if you did exit below that, you could wait for a bull bar and buy above that, or you could buy above the prior high above that. So to me, I'm a discretionary trader, and that means I evaluate every situation based upon what is in front of me at the moment. But in terms of general rules, when in doubt, get out. And a general rule, if the bars are 10 points tall, I would get out 5 points below a bull bar if the trend is not all that strong. And I'd get out 1 tick below a bear bar closing below its midpoint. If it's a bear bar not closing below its midpoint, I might get out 4 or 5 points below the bear bar. But if the trend is really strong and there's a bear bar, especially if it's fairly early in the trend, I'm going to buy the close of that bear bar or buy below the bear bar, not exit. I'll wait for 2 bear bars or 3 bear bars and then sell. My break even often gets hit at my entry before hitting my profit target. In other words, he's moving his break even after 1-to-1. Okay, that's what it says. I'm taking credible swing trades according to your daily setups. Any advice on better market timing? This is a common practice. It's fairly common. You'll hear me sometimes say, early in a trade, especially in the open, the market's going to do something to make you get out. And if the trade is valid, you hold on to your trade. So for today, it did 7. It scared out weak bulls, but you could always buy again above 11. And that day that I showed you from the other week, here, the bears got a low 1, a low 2. Here we got a pair of bear bars, but after 10 bull bars, probably a minor reversal. Okay to get out. I would not get out below that. But a second one, okay to get out. You can always buy again above that. And he's saying that he buys above this bar, and he tries to scalp out 5 points. It hits his limit order, does not fill it, and then it comes back down to his entry price here, and he gets scared and he gets out break even. I would not do that. I would, like I said, get out below bear bar closing below its low, and until you get this, a breakout, you have to allow for the market to do things that are scary. Come back to your entry price, get a bear bar. But once you get the breakout, then you can use a tighter stop, put it there or put break even. But if you're buying, the opposite is true for selling. But if you're buying, looking for a swing and looking for a breakout, you want this, right? But sometimes you don't get that. Sometimes it does this. You buy above that, and it does this for several bars. So for 3 bars, it's still at your entry price. And I would rely on my stop as long as you're not getting bear bars or good sell signals. Rely on my stop and then wait for the breakout. And then you could tighten your stop to maybe break even. But remember, only 40% of swing trades become swings. 60% of swing trades, they go a little against you, a little in your direction, and you scalp out with you become disappointed and you scalp out with a small win or small loss. So 60% of swing trades, you basically, it's break even. And 40% of swing trades, you make 2, 3, or 4 times your initial risk. Question, do you think the probability of having a complex 2-leg or a complex leg 2, like after 38 to 45, was reduced because of the big bar 45 as bears exited taking profits? No, I don't think so. I think, so he's saying is 45 the opposite of 69. That's not all that late in a bear trend. 69 is 20 bars into a bull trend, and 45 is a bear breakout. The bears were hoping it would lead to a measured move down. They were likely to get at least a second leg down, and that's all they got was a second leg, a little bit down, mostly sideways. So, is it going to be a complex 2-legged move? Is it going to be 1 and then lower high 2? I thought so, but then 49 closed on its low. That reduced the chances, and then we had bull follow through 50, 51, and on 50 or 51. You have to assume the correction is complete and that the midday reversal is going to fail, and that we're going to break above the high 38 and walk for about a measured move. And measured move from at least the last leg down. We went a little bit more. But I don't think 45 would attract profit takers. If anything, bears taking profits. If anything, it would make bears hopeful. But a lot of bears would not sell the close. They would want to see a follow-through bar. And 46 was a bull bar and not a bear bar. So that made a lot of bears give up above 47, above 46. They have a low one, 47, and then you get that outside up 49. All right, hope everybody has a good night. Tomorrow could be interesting with the unemployment report. It could get a big move up, a big move down. As you know, I'm hoping we get one more new low. I'm hoping that we're at the top of the channel and we collapse and get a new low and then a reversal up. It's, I would say there's at least a 40% chance that this will remain the low of the year. So there's better than 50-50 chance it's not going to be. But if we get 2 or 3 or 4 more good bull bars, then it becomes 50 or 60% chance that this will be the low for the remainder of the year. All right, hope everybody has a good night.